In this lecture, we will cover the CFA Level 2 reading on market-based valuation, and our focus will be on price and enterprise value multiples. This is the table of contents. The meat of this reading is right here in sections 3 and 4. In section 3, we go over several price multiples. The most important one is the PE multiple. So perhaps most of our time will be spent right here. And then enterprise multiples are also important. These sections are relatively short. A very quick introduction. I'm sure you know this already, but just to get the ball rolling. Price multiples are ratios of a stock's market price to some measure of fundamental value per share. So always in these price multiples, the numerator is the current share price. Then the denominator could be earnings per share, book value per share, or some other measure. And we'll be going over several price multiples in this video. Then enterprise value multiples. These relate the total market value of all sources of a company's capital to a measure of fundamental value of the entire company. So notice that these multiples are from the perspective of a stockholder or an equity holder. But what if you want to take the perspective of all investors? Then the most commonly used enterprise value multiple is the overall enterprise value, and we've talked about this concept in an earlier reading, divided by some measure of cash flow or some measure that applies to all providers of capital. And the one that is used most often is EBITDA. Just a few high-level remarks on price and enterprise multiples in valuation. Broadly speaking, we will be talking about two types of methods: the method of comparables and the method based on forecasted fundamentals. With the method of comparables, we use a price multiple to determine whether an asset is relatively fairly valued, undervalued, or overvalued. And you need to understand why this relative is so important. Since you are comparing with other companies, you can only say that this stock is overvalued, undervalued compared to the other company. So that's why we use the term relatively fairly valued or not. Now, before I get to this concept, I'll just very quickly explain what we are talking about here. Let's say that you are evaluating a particular auto company, and the earnings per share on this particular auto company is 5. So 5 rupees per share or $5 per share. And a set of comparable companies have a PE multiple of 10. So what is the projected price or the anticipated price, assuming they are comparable? The projected price would be 50. So here we are using a method of comparables to come up with price. Now, what about a multiple? So let's say that the actual multiple for this company, it is trading in the market, and the comparables are on average trading at a multiple of 10, but your target company is trading at a multiple of 11. All else equal, is your target company, which is trading at a multiple of 11, overvalued or undervalued? It is overvalued because the price per dollar of earnings here is 11 for the target company, whereas for the comparable companies, that same multiple is 10. So our target company is overvalued. Now think about the underlying principle here. The underlying principle is the law of one price. In simple terms, the law of one price says that similar items should sell for the same amount. Okay, so what we are saying is if you have two auto companies which are exactly the same, then they should sell for the same price. Now, what if two auto companies are the same, but realistically their earnings are different? So one company has an earnings of 10 million, the other company has an earnings of 20 million. So are they same? sort of, but not exactly. What we then look at is the price to earnings ratio. So what amount are you paying per dollar of earnings? And that's what the PE does for you. So if two companies are similar, just one is larger than the other, and this just connects back to something that you learned very early in your life when you talked about similar triangles. What are similar triangles? Two triangles that look the same but the size is different. So when we say similar companies, in a sense we mean the same thing. If two companies are similar, that doesn't mean the size is the same. It just means that they are same in all other respects. The ratios are the same. So law of one price would say that the price per dollar of earnings needs to be the same. In my example here, if for your target company the price per dollar of earnings is high, that means that this company is currently overvalued in the market. The other method is based on forecasted fundamentals. This relates the price multiple. Again, we'll take my favorite or most people's favorite multiple, which is the PE. And we are saying that for a given company that you are evaluating, the PE multiple depends on or is a function of fundamental factors related to that company. For example, if we say that the PE of a company depends on its growth rate, on its discount rate, on its, some other factors that are related to this particular company, then we say that this PE is based on the forecasted fundamentals of the company. Again, we are coming up with a PE, but the method of coming up with the PE is different relative to the method of comparables. This is a very simple example of the method of comparables, and it is something that you have seen at level 1, but at times people are a little confused about this. So I want you to try this and get the right answer before you move on. So this is what you should get. If company A stock is trading at 37.50, its PE is simply 25. So this is the current market price divided by 150. If the companies are similar, this PE should indicate that company A is overvalued relative to B. Why? Because using this method, we are coming up with an actual PE of 25 based on the market price. But according to the law of one price, what is the PE? As in, the PE of company B is 22. So if the law of one price holds, and we are using B as our basis here, then A should also be at 22, but it's not. It is at a higher PE, so it is relatively overvalued. If we assume that company A stock should trade at about the same PE as company B stock, we will estimate that an appropriate price for company A stock is 33, which is simply A's earnings times 22. All right, now we come to the meat of this reading, price multiples, and we'll talk about various price multiples. Most of our time will be spent on price to earnings, but then we'll also look at price to book value, price to sales, price to cash flow, price to dividends, and dividend yield. This dividend yield is actually used much more often than a price to dividend ratio. So our focus in section 3.5 will be on the dividend yield. Price to earnings. A stock's trailing PE ratio, sometimes referred to as the current PE, is its current market price divided by the most recent 4 quarters EPS, or earnings per share. In such calculations, EPS is sometimes referred to as trailing 12 months or TTM EPS. Sometimes, in fact, quite often in the financial world where we need to take a forward-looking perspective, we quote or are given forward PEs. These are also called leading PEs or prospective PEs. The forward PE is the stock's current price. So notice in both cases, the price is the current price. So if this is the current point in time, we take the price at this point in time. With the trailing PE, we divided price by a trailing EPS. With a forward PE, we divide price by a EPS in the future. Why use price earnings for valuation? In other words, why do you say that, look, this company should have a PE of 10, its earnings are 5, so the value should be 50? Why do we do that? A big reason is that earnings is a key driver of value. When you say this company is valuable or this company is not valuable, one of the most important things you look at is the earnings that are being generated by that company. Clearly, a company that is generating higher earnings should be more valuable than a company that is not generating high earnings. Number two, PE ratio is widely recognized and used by investors. In fact, if you look at sell-side research reports on several companies, one of the most commonly quoted multiple or a commonly referenced multiple is the PE ratio. So it is widely used in the industry. And three, differences in PEs may be related to differences in long-run average returns. This connects with a reading you did at level 1, a reading in equity on anomalies. You might recall that in looking at equity markets, one anomaly that was highlighted was that companies with relatively low PEs tend to outperform companies with relatively high PEs. So a lot of people do believe that. A low PE implies that the valuation is relatively low. So if there is some evidence which suggests that companies with relatively low valuation in the future are likely to outperform companies with relatively high valuation or with relatively high PEs, then obviously the PE is an important ratio to consider. Okay, what are the drawbacks of using the PE ratio for valuation? The obvious one is that if the earnings per share is negative, which is possible in certain quarters, it is also possible that the EPS is 0 or close to 0, then the PE would be meaningless. Earnings contain volatile transient components. As you have seen in detail in financial reporting and analysis, the earnings can be up and down. Sometimes there might be restructuring charges which bring earnings down. Sometimes there might be one-off gains which take earnings up. So one has to be careful about the fact that earnings might have components that are volatile or transient. And finally, management's choice of accounting policies may taint EPS. We won't spend much time on this because, again, this material has been covered in detail in FRA. Different companies might make different assumptions about depreciation, about operating leases versus finance leases, and a host of other items. And those different management policies and decisions will obviously impact the EPS number. How do we calculate the trailing PE? When using trailing earnings to calculate PE, the analyst must take care in determining the EPS to be used in the denominator. Specifically, here are the items to consider. And most of this should look reasonably familiar. At level 1, you might recall studying the concept of basic EPS versus diluted EPS. So if a given company reports both, and generally companies are required to report both basic EPS and diluted EPS, if you are coming up with a PE ratio, you are a financial analyst. So in the denominator, what should you use? The basic or the diluted? It makes more sense to use the diluted EPS because if you are comparing companies with different capital structures, two different companies might have, a different capital structure in terms of one company has issued convertible preferred shares, the other has not. So to bring different companies that you are comparing on the same page, to do a apples to apples comparison, it makes sense to convert, or it makes sense to use the diluted EPS. And that is emphasized in example 2, which I'll not go over because it's a really straightforward point. Next point, transitory non-recurring components of earnings that are company specific. You need to deal with these. So what should you do? If something is non-recurring, it's just there for a given quarter, and you are using your PE to compare, and obviously at the end of the day, you are concerned about what will happen in the future. So what should you do with these transitory non-recurring components? You should remove them when making comparisons. And what is the formal term for coming up with an EPS after removing these components? We generally refer to that as the adjusted EPS. This is highlighted in example 3 in the curriculum. So I want you to take a quick look at this and then I will comment. What you will notice here are several one-off charges. So a 0.06 per share charge of for restructuring, 0.07 amortization of intangibles arising from acquisitions. There's an impairment charge. So does it make sense to potentially adjust out these numbers when making forward-looking projections or when making comparisons? The answer is yes. And here is what the company has done. It has used this term called core EPS, and this is a term that you might also have seen in IFRS. This is the term you have also seen in FRA. Is core EPS an IFRS or US GAAP term? It's not. This is a term that a company is itself coming up with to try and depict its core earnings after taking out the impact of one-off items. So the company itself is reporting a core EPS over here. All right, I'm not going to go through all these details, but effectively what we are being asked to do is determine EPS and determine PE using the reported numbers as well as using the adjusted or the core EPS numbers. The calculation is fairly mechanical, and obviously you'll come up with different answers depending on which definition of EPS you use. From an exam perspective though, these are the comments on the particular example that we are just talking about, which you must master. By any of its various names, the underlying earnings or core earnings is a non-IFRS concept without prescribed rules for its calculation. So a company obviously might have an incentive to show high earnings. So it might classify items as non-recurring, which are not really non-recurring. You as an analyst need to be careful about that, and specifically here is what you do. An analyst's calculations of underlying earnings may well differ from that of the company supplying the earnings numbers. Company reported core earnings may not be comparable among companies because of differing basis of calculation. Analysts should thus always carefully examine the calculation and generally should not rely on company reported core earnings numbers. So this is quite self-evident and important, hence it's been emphasized. In general, the PE that an analyst uses in valuation should reflect the analyst's judgment about the company's underlying earnings and should be calculated on a consistent basis among all stocks under review. So again, fairly self-evident and something you need to be careful about. Bottom line is, don't just take the core EPS or the underlying EPS given by the company, because every company will use its own assumptions. You should do that adjustment on your own. The next point has to do with transitory components of earnings ascribable to cyclicality. And the point here is that an economy obviously will go through cycles. Even the cycle might impact different industries differently, but in many cases you will have a situation where a company is doing well when the economy is good. In other words, the EPS will be relatively high, and when the economy is not doing well, then the EPS will be relatively low. So what do? If you are at the bottom of a cycle, should automatically the PE multiple go up because the EPS is low, or does it really make sense to consider the cycle as a whole and maybe use an average EPS number? The answer is it does make sense to use some sort of an average EPS number. And this process of taking the average is called using the normalized EPS. Normalized earnings for cyclic companies are earnings expected under mid-cycle conditions. And there are two methods for calculating normalized EPS. So if we look at it this way, let's say that this is the business cycle. And what you can do is take a particular company and figure out the EPS during different parts of the cycle and then take the average. That is the simple historical average method. Average EPS over the most recent full cycle. The other method, which actually is theoretically more appropriate, is to use the ROE method. Here, normalized EPS is equal to the average full cycle ROE multiplied by the current book value per share. What is the book value per share? It is simply the equity of the company. Okay, so as you'll see in the example which is coming up, this method better deals with the situation where a company is growing during this cycle. And also note what we are talking about here. What is ROE? It is the net income over equity. So we take the average ROE of the company, which might not be changing too much. So if a company is relatively stable, this number might be relatively stable, the net income over equity. And then if the company is growing even at a moderate rate, then what's going to happen to the book value per share over the cycle? The book value per share or the equity per share is going up. So overall the impact is still the same. You are taking this average number and multiplying by equity, so you are still getting an estimate for the net income or the EPS. So let's look at an example. So I want you to read this and then look at these numbers which are along the lines of what we are talking about. And then simplistically, we are going to come up with the normalized EPS and the PE based on the normalized EPS. And we'll also use both the methods that we've just talked about. Focus on the concept. The calculation is fairly mechanical. All right, so hopefully you've gone through this. And it's fairly straightforward. Averaging EPS over the entire period, so these are the EPS numbers that you just saw, divided by 7 because we have 7 years in this period. This is 0.43. So using the historical method, your average EPS is 0.43, and then the PE will simply be the stock price over 0.43, which is this. The average ROE can also be calculated because your ROE in each year is given. That average number is 16.39 based on the current book value per share of 3.43. So notice that is at the end of 2007, the book value per share is given. So you take the average ROE number and multiply by the book value per share, and you get 0.55 as your EPS. Notice this number is higher than what you had earlier, and therefore the PE number is going to be lower. And then from a testability perspective, this is important, the distinction between the two methods. Over this period, the book value per share increased from 1.58 to 3.34, an increase of about 111%. So the company obviously grew a lot. The estimate of normalized EPS of 0.55, which we have over here, from the average ROE method reflects the use of information on the current size of the company better than does the 0.43, which is calculated using the historical average EPS method. Because of that difference, the company, TSM, appears to be more conservatively valued when the method based on average ROE is used. All right, next point. Differences in accounting methods. What are we doing over here? So I'm back to this core slide where we are talking about calculating the trailing PE, and the point being emphasized is that it's not just simply a matter of taking the price and dividing by earnings over the last 4 quarters. There are several things that you need to consider. So now we are talking about differences in accounting methods. This obviously is particularly important when you are comparing different companies. So if one company uses LIFO, another company uses FIFO, obviously you need to make an adjustment. And I won't spend much time on this because in FRA we've talked about all sorts of differences between IFRS and US GAAP, and the fact that you need to bring both companies to the same standard, make adjustments so that you can compare. What do you do if the earnings are extremely low, zero, or negative? Then obviously this method doesn't work too well. When your earnings number is low or negative, then it makes sense to look at some of the other ratios that we will talk about. And here is a quick summary of the other ratios. We've already talked about the PE. At times, in fact, quite often, we also look at the inverse of these ratios. What's the inverse of the PE ratio? It is the earnings yield, or E over P. What does the earnings yield tell you? It tells you the earnings per dollar of price. Okay, when you buy something for $10, that's the share price, and the earnings is 1, so your earnings yield is 10%. And both these forms are commonly used. Then the other ratios that we'll talk about, price to book is the price per share divided by book value per share. The inverse is obviously B over P. Price to sales, inverse is sales over price. So you can read all these, they are fairly self-evident. We've talked about the trailing PE, now let's come to the forward PE ratio. The forward PE is a major and logical alternative to the trailing PE because valuation is naturally forward-looking. In the definition of forward PE, analysts must interpret next year's expected earnings as EPS for either the next 4 quarters or the next 12 months or the next fiscal year. The point being that just because you are given a forward PE number doesn't mean you know exactly what the definition of forward is. So when you are presenting a forward PE, you need to clearly explain what is meant by forward. Is it the next 4 quarters, the next 12 months, or the next fiscal year? So when presenting, you need to clearly present what the forward number is. If you are absorbing or reading that information based on what somebody else has given you, you need to understand the underlying definition. And that is highlighted over the next couple of examples. So let's look at this one very quickly. This is easy, and then the next one is a little more complicated. So this is straightforward. What is the forward PE? You are asked to calculate the forward PE based on the fiscal year definition for fiscal year 1. What's fiscal year 1? It is 2008. So you take the stock price, which is given right here, divide by the EPS for the fiscal year 1, and you come up with 14.8. When you take fiscal year 2, then you need to take the EPS or the estimated EPS for fiscal year 2, which is 9.59. So the stock price doesn't change, obviously, but the denominator changes. So you have a different PE. Now this is an excerpt from example 6. In the curriculum, a lot is written, but what I'll try and do in many of these examples is just present the most relevant excerpt from the example. So I want you to try and do this. This is the date, 21st November 2007, and the information is presented right here. So notice that if this is the date, 21st November 2007, so you are in the 4th quarter of calendar year 2007. And fortunately for us, the calendar year and the fiscal year is the same for this particular company. We are somewhere here, so late November. All previous quarters in 2007, quarter ending 31st March, 30th June and 30th September, these are actual numbers. And then this quarter is where we are, the 4th quarter of 2007. Here we have an estimated number because the quarter isn't over, so the number hasn't been reported. And then this is the next fiscal year, also the next calendar year. and we are given the estimates for all 4 quarters. So there can be several definitions of the forward EPS. One definition would be based on the next 4 quarters. What is NTM? Next 12 months. Then you can have a definition based on fiscal year 2007, which is nearly over but not yet over. So this would also classify as a forward PE. Or you could have a PE based on fiscal year 08, right? So what are the 4 different PEs over here? I want you to quickly see if you can calculate them. It should be easy. All right, so here are the answers. The question actually asks you to calculate the PE, but the price is given. So actually the real point underlying this is to come up with the EPS for these 4 scenarios. So that's what I'm focusing on. When we say next 4 quarters, we also mean the current quarter. That is the convention. So because the current quarter's numbers have not yet been reported. So for item 1 over here, you simply take the next 4 quarters, starting with the current quarter, and take the next 3 quarters, and you come up with an estimated EPS of 0.07. Then next 12 months, here is the convention. What you do with next 12 months is, for the current fiscal year, there is just 1 month left. So you take the overall estimate for the full year and multiply that by 1 over 12. Then you take the estimate for the next year and multiply it by 11 over 12. And that gives you a fairly different EPS number. Then the third one is estimate based on fiscal year definition and current fiscal year. The curriculum makes this slightly complicated when you look at their explanation, but if we are saying the definition is fiscal year 07, then just take the fiscal year 07 number minus 0.56. And finally, estimated EPS based on fiscal year 08, there you simply take 0.3. So once you understand what's going on, it is straightforward, but look at how this has evolved since level 1. At level 1, you just said, okay, it's the EPS in the future, but now you recognize that it's important to understand the exact definition of the future in this context. All right, we've talked about valuation based on comparables. We've talked about the definition of EPS. Now let's talk about valuation based on forecasted fundamentals. This is an important little excerpt from the curriculum which I'll read for you. The analyst who understands DCF valuation models can use them not only in developing an estimate of the justified PE for a stock, but also gain insight into possible sources of valuation differences when the method of comparables is used. Linking PEs to a DCF model helps us address what value the market should place on a dollar of EPS when we are given a particular set of expectations about the company's profitability, growth, and cost of capital. So we are now going to look at the simplest of all DCF models, which is the Gordon growth model or the constant growth model, and see how that model can be used to come up with the PE. And this is something that you've also covered in previous readings, so hopefully this is not an issue. You recall from before that the price of a share based on the Gordon growth model, and assuming obviously constant growth, is equal to D1 over R minus G. All we are doing now is coming up with a multiple. So if you divide this by E1 and this by E1, then what do you have? You have the leading PE ratio is equal to the payout ratio divided by R minus G. And if B is the retention ratio, then instead of payout ratio, you can write 1 minus B, which is what's given over here. So notice that here the PE is based on the fundamentals of the company. It's based on 1 minus B, which is the payout ratio. R depends on the riskiness of the company, and G depends on the growth rate. So based on fundamentals. What about the trailing PE? That is given by this expression over here, and you can see the algebra. You've also done this before. And again, I'll emphasize a point that I made in an earlier lecture. If G is positive, in other words, you have a growing company, then the trailing PE should be higher than the leading PE. All right, here are a couple of quick examples. You are given some information, and based on that information, you can easily calculate the PE based on fundamentals. So this is example 7, this is example 8. I want you to read example 8, which seems simple, but there is something slightly tricky that I'll emphasize after you have gone through this. Okay, so now here's an important point. What is Toyota's PE based on forecasted fundamentals? This is now the justified PE, or what is the PE that is justified based on the fundamentals? Are we given the PE based on market price? So if you look at the numbers given, you are told that the market price is 5480. And are we given the FCFE? So you use an FCFE model, and based on FCFE, the value is 6122. And what else are you given? Are you given the EPS? You are given the EPS of 580. So there are two different PEs you have over here. One PE is where you take the market price and divide by 580. You also have a multiple where you take the value and divide by 580. When you take the value and divide by 580, this gives you the justified multiple, because this is the number that is justified based on the fundamentals of the company. So when you take this number and come up with the multiple, that is called the multiple which is justified based on the fundamentals. If you take this number and divide by the EPS, this number is the market price. So this is the actual PE. So which multiple will be higher? The PE, the justified PE will be higher. All right, now all this second point is saying is that there are two ways of expressing whether a company is overvalued or undervalued. The very basic way is to say that, look, actual market price is 5480. When I do an analysis based on fundamentals, I come up with a value of 6122. So this company, the market price appears to be undervalued. Okay. Can you make the same conclusion looking at the PEs? The point being emphasized in this example is that stating in terms of PEs or stating in terms of actual prices, there are two ways of doing the same thing. They are equivalent. So if you say that the justified fundamentals based PE is high relative to the actual market PE, then that also implies that the stock is undervalued in the market. So that is the point being made. All right, so we've talked about a comparison-based method for coming up with PEs. We've talked about a fundamentals-based method. Now, this is a third method which connects with regression, something that you've studied in quant. Predicted PE based on cross-sectional regression. This might seem a little different from everything else in this reading, but it is mentioned explicitly in the learning objectives, and hence I am covering it. A predicted PE is conceptually similar to a justified PE and can be estimated from cross-sectional regressions of PE on the fundamentals believed to derive security valuation. This might seem a little complicated, but at least what you need to know is not particularly complicated, and it's illustrated in example 9. You are valuing a food company with a beta of 0.9, a payout ratio of 0.45, and an earnings growth rate of 8%. So you are given the fundamentals of your particular target company, which you are valuing. The estimated regression of a group of other stocks in the same industry is given by this equation. So just imagine that some researcher has done the following for you. They have taken a bunch of comparable companies, peer companies, and run a regression that looks at what the predicted PE is based on certain fundamental factors. They run the regression and they give you this particular regression equation. Will this equation be the same for every industry? No, obviously the coefficients will be different. Maybe the value drivers also might be different depending on the industry, but in your context, for your relevant industry, you are given this equation. Then how do you come up with the predicted PE for your particular entity, your particular target company? Just plug and play, right? You've done this in quant. So you take the numbers given, plug them in, and you will get your answer. So when you plug in the numbers, this is what you get. If the actual PE in the market is 18, then is this stock overvalued or undervalued? The stock clearly appears to be overvalued. And this question about whether the stock is overvalued, undervalued, this keeps coming up. It's very straightforward. So you need to be on top of this particular sort of question. You also need to understand the limitations of this method. The first one is that such models capture valuation relationships for a specific time period. The predictive power in another time period is not known. This is a classic regression issue. When you run a regression, let's say you ran this regression for the last 2 years. Does that mean that the relationships over the last 2 years will hold in the future? Not necessarily. Regression coefficients and explanatory power of regression tends to change substantially over time. So these are classic regression issues. And one that you might recall from quant is multi-collinearity. What does multi-collinearity mean? This means that the independent variables might have a correlation with each other. So in a regression context, if independent variables have a linear correlation with each other, then that is bad. In other words, you cannot then trust the regression. So if you think about this exercise, what are the independent variables? Dividend payout ratio, beta, growth. Do you think there is any sort of a relationship between the payout ratio and growth rates? There might be. So a big issue with such models is that of multi-collinearity.